Hey everyone, happy Thursday, May 25th. It's a little bit after 10 a.m. on the West Coast, and the weather's been beautiful over the last week. But unfortunately, the markets have been not so pretty. And that's all because of the debt ceiling drama. It continues to intensify. I heard this morning that it sounds like they're making some progress on a deal, which is great. But every bit of news that's come out has made the markets go up and down. Things have been very volatile. In fact, the credit rating agency Fitch downgraded the United States last night to rating watch negative because of this volatility. And the problem being is that even if this gets resolved, we're not quite sure how this will, mortgage rates will handle this. Remember, we hate inflation. So if they make a deal on this spending and it's a lot of spending, the markets might not like that. So hopefully they come to an agreement in the middle somewhere where spending's not too crazy and they get everything resolved. The next thing is going on right now that I really want to talk to you guys about is a little bit more on the technical side of things, which I stay away from. But banks and the FDIC have been selling mortgage bonds, and this is creating quite a bit of pressure on mortgage rates up. So this is a really telling graph. And so the yellow line is bank deposits. So the money all the banks across the United States have in billions of dollars. And the gray line is money market accounts. So, not banks, but, a money market account where you can put some money in on a short-term, long-term, however, depending on the program, and make some, short-term money off of it. So since things have, the Fed has started raising their rates, money has been fleeing bank deposits and been going into money market accounts because the rate of return on those has been going up. And you can see right here where it crossed over. That's right about when we had SVB and those bank collapses. And ever since then, it's kind of intensified. We kind of saw it, drop back a little bit, but since then it's not getting any better. And the problem being here is that when people take money out of their bank, the bank is forced to sell mortgage bonds and treasuries in order to give people their money. And that's been happening a lot. So the more mortgage bonds are sold, the more that drives mortgage rates up. So besides the narratives, besides the debt ceiling, inflation, all that kind of stuff, we also are dealing with this technical thing where basically people have just been taking, money out of banks, which is creating the banks to sell mortgage bonds, which is making mortgage rates go up because mortgage bonds go down when there's a bunch of selling. So that is something that's not good. Hopefully that tapers out soon. Hopefully basically they sell everything they have and we stop seeing a negative push on that. The next thing we got April new home sales. So they were plus 4%, but March was revised a little bit lower. So basically it became a wash. So annual sale pace is is up 4.1% month over month, but flat when considering the revision. It's up 11.8% year over year. Flat month over month with both for sale and total inventory. And then, the reported a month supply shows 7.6, but we know that they're completing about 70K a month and the monthly sales pace is 57K. So really there was only about a 1.2 month supply. So keep an eye on that because I've seen some articles talking about this glut of inventory, new home sales. And the other thing I saw in an article last night was talking about new homes, the price dropping quite a bit. And it is down 7.7 month over month and 8% year over year. But we also know that a lot of the builders are starting to build smaller homes. And we know that the median prices are going to be driven by that. When things that aren't as expensive stop selling and more less expensive things start selling, then that's going to drive down that median home, whether it's new home sales or existing home sales. So the next thing we got was April pending home sales. So that was just flat, unchanged month over month. And the Northeast really dragged down the rest of the country. If you look, Midwest was up 3.6. Out here in the West Coast, we were up 4.7. South was up just a little bit, 0.1. The Northeast was down 11.3%. So if it wasn't for the Northeast dragging the rest down, that actually probably would have came in as a positive number. And the NAR, the National Association of Realtors, Dr. Lawrence Yoon, like he said, it's not a rate problem, although that's not helping. It's not a demand problem. It's actually an inventory problem. There's not enough inventory out there to meet demand currently. If there was more inventory, there would be more sales. Next thing, we got initial job claims. This is always important. Unemployment, we know the Fed is keeping a close eye on this. It was expected to be at 250K. It came in at 229K. However, last week came in at 242K. That was revised way down to 225K. So this month was actually, or this week was actually up 4K. So as again, with these weird revisions, all this back and forth, it's hard to trust these numbers when they put them out and then a week or a month later, whenever they make revisions to it. So it's all very, very interesting. Purchase apps down almost 5% last week, down negative 26% year over year. Again, rates have been going up quite a bit, and therefore apps are down. And again, inventory being down does not help apps as well, because generally people see something they like and then they apply with somebody like me. Next thing we got was miscellaneous stuff. So GDP, the GDP quarter one estimate came out today. It was supposed to be 1.1% growth. It showed 1.3% growth, which is a little alarming just because it gives the Fed more ammo to keep doing what they want to do. But it's also down from quarter four of 2022. That was at 2.6. So it's basically been cut in half since then. So that shows a slowing economy. And then, I think Germany officially went into a recession today, and recessions tend to be global. We're trying to deny it here in the United States, but again, that recession word is out there. Fed speakers and minutes. So we got the minutes from their last meeting. It looks like it was a mixed bag for this upcoming meeting, what they think they want to do coming up on June 14th, whether they want to raise or not. And then the speakers have been a mixed bag over the last week. A lot of negative talk, but then Powell on Friday, Fed Chair Powell actually, hinted at a pause. So again, I don't think they know what they're going to do at this point. So we're just going to have to keep an eye on everything. And the next thing we got was CoreLogic loan performance. So CoreLogic, tracks basically how people are doing on repaying their loans. And this, again, came in really good. So the green is March 2022. The gray is March 2023. And across the board, either down or remain flat. And why this is good is because people are repaying their loans. We know that current homeowners are in a good position, compared to these numbers were 6 times as large during the housing crash in, 2007, 8, 9, that era. So we know that homeowners are doing a good job right now, either coming down a little bit, staying very flat. And that is good for the overall health of our economy and overall health of the housing industry. And where does that leave us? So it's disgusting, but the average rate jumped from 6.7 to over 7% to 7.03 since last Thursday. Obviously, this has a lot to do with what I've talked about with the debt ceiling, the bank selling a bunch of bonds. Basically, every piece of news seems to be going against us. So, we need news to start going in our favor. Tomorrow we get the PCE inflation data, and I'm not quite sure how that will come out. We know this is for April. We know in April we had that the used car sales jumped quite a bit and oil prices jumped. So that might reflect in this. And so we might not get very much gain out of that. And then we got the, June BLS jobs report coming up on June 2nd. And then CPI, the really important inflation one we want to look at, that's coming up June 13th. That's the day before the Fed has their next meeting. So based on how that come out, that might be, what it comes down to. Right now, the markets show 55% chance they're going to not hike and a 45% chance they're going to hike. So a coin flip, a weighted coin flip, like we talked in the poker industry. So we'll see what happens. We need the data to start going in our direction. We need this drama with the debt ceiling to go away, preferably somewhere in between so the markets don't react negatively to a bunch of spending. We need a lot of things to go in our favor to stop this drama. But like it shows that a lot of people, the days on market drop and stuff like that. So the people that can't afford to buy and they find something are buying. So it's not just those rates, not what we're dealing with. We also need that inventory to tick up. But if rates do come down, we might see more inventory because people would be more willing to sell and take on a lower rate. So that's, all I had for you guys this week. There's a lot of going on. Like I said, we got to cross our fingers and hope things start to go our way in the data and also in the narrative. I hope everybody has a great Memorial Day weekend, happy and safe Memorial Day weekend. Enjoy times with your family. And let's hope by this time next week that things are a little bit less volatile. Have a great day, everybody.